Hi, I'm Dong Shong. Welcome to Digging into China, where we explore China in depth to reveal unique perspectives. On May 20th, China's 6 major state-owned banks and 9 joint stock banks collectively reduced their deposit rates, ushering China into an era of 1% deposit rates. For state-owned banks, the one-year fixed deposit rate has now fallen below 1%, standing at just 0.95%, while the 5-year deposit rate is only 1.3%. Such low interest rates are unprecedented in China's history. Yet, the question remains, are these rates low enough? The answer is far from it. Given the bank's razor-thin net interest margins, they would likely prefer to push deposit rates into negative territory. Imagine depositing money in a bank and not only receiving no interest rate, but also paying a fee to store your funds. This may sound far-fetched, but Japan, which endured prolonged deflation, experienced a period of negative interest rates. Could China follow the same path? In this episode, we'll systematically explore whether China might enter a negative interest rate era, and if so, how soon we might witness this historic shift. First, let's clarify what negative interest rates are and how they arise. Is it simply a matter of the central bank issuing a directive mandating negative deposit rates for commercial banks? If you believe it's that straightforward, you are mistaken. Consider Japan's experience in 2016 when it entered the negative interest rate era. The Bank of Japan announced a negative 0.1% rate on the excess reserves held by financial institutions at the central bank. In essence, commercial banks earned no interest on those reserves and had to pay the central bank a 0.1% fee. If you were a bank, what would you do? Faced with this added cost, you'd likely seek to offset it elsewhere. And who would bear that burden? Depositors, naturally. In Japan, commercial banks slashed deposit rates to a mere 0.001%, virtually zero. Large deposits began incurring management fees, and the returns on wealth management products dwindled to nearly nothing, with additional fees attached. In short, money deposited in Japanese banks shrank over time. This is the mechanism behind the negative interest rates. If China were to enter a negative interest rate era, the People's Bank of China would likely adopt a similar approach. The central bank would pressure commercial banks, which would then lower deposit rates or impose fees on depositors. For us as depositors, the result would be the same. Our bank deposits would cease to generate interest. Having established what negative interest rates are and how they are transmitted, we must now assess whether China is heading towards this scenario. 4 key signals can help us determine this. If these signals converge, the negative interest rate era may indeed be approaching. The first signal is the most visible: nominal interest rates. The one-year fixed deposit rate is now 0.9%, which many consider remarkably low. However, a more critical factor is the real interest rate, the actual return after accounting for inflation or deflation. If the consumer price index is negative by 1% this year and you earn 0.9% interest, your real purchasing power increased by 1.9%. Thus, even nominal rates drop to zero, deflation ensures your money's value grows. But this also implies that the persistent deflation will force the central bank to continue cutting rates, and the banks will have to further reduce deposit rates. How close are we to negative rates? Consider this. The one-year rate is 0.9%, the 5-year rate is 1.3%. A few more cuts could bring us to zero. The second signal is the CPI, Consumer Price Index. Official data shows China's CPI hovering near zero, but in reality, inflation has given way to deflation. Consumers are reluctant to spend, and the business is hesitant to expand despite access to loans. Both consumption and investment are contracting. If you were the central bank, what options would you have? You need to stimulate spending. If the rate cuts prove insufficient, negative rates may follow. If depositing money means no interest and a fee, would you still keep your funds in the bank? As long as the CPI remains stagnant, resembling a lifeless economy, the central bank will deploy its interest rate tools more aggressively, pushing deposit rates downward. The third signal is the Chinese yuan's exchange rate. When Japan adopted negative rates, capital flight wasn't a concern. In fact, it led to the Mrs. Watanabe phenomenon, where Japanese investors borrowed cheap yuan, converted to foreign currencies, and invested abroad to earn higher returns or benefit from currency appreciation. The government did not intervene. China, however, is different. Negative rates could trigger rapid yuan depreciation and massive capital outflows. The Chinese government would need to defend the exchange rate to prevent uncontrolled capital flight. If the $50,000 annual foreign exchange quota tightens, forex approvals grow stricter, or the central bank frequently intervenes in currency markets, sometimes overnight, these could be precursors to negative rates. The final and most critical signal is whether monetary policy has become ineffective. If rate cuts and the reserve requirements reductions fail to stimulate activity, and households and businesses remain passive, neither spending, investing, nor expanding, China will have entered a liquidity trap. At that stage, the central bank's only recourse is to push rates into negative territory, compelling people to spend. This fourth signal is already evident. Thus, we must seriously consider how soon the negative interest rate era might arrive. Japan serves as China's primary reference as one of the few developed nations to endure prolonged deflation and negative rates, still grappling with deflation's lingering effects. Let's revisit Japan's journey to negative rates. It began in the early 1990s when its real estate and stock markets collapsed, erasing over half their value and plunging the nation into a lost 2 decades. The Japanese government responded with massive infrastructure spending, but it had little impact. After the asset bubble burst, households and businesses focused on deleveraging, prioritizing debt repayment over borrowing, spending, or investing. The Bank of Japan then launched successive rate cuts, steadily lowering interest rates to stimulate the economy with affordable loans. By 1999, Japan's policy rate was near zero, marking the start of the zero interest rate era. After 2001, the central bank introduced quantitative easing, yet with businesses avoiding bankruptcy and households refraining from spending, even continuous money printing and stimulus failed to spur growth. Japan had fallen into a liquidity trap. In 2013, the Abe government launched Abenomics, combining monetary easing, fiscal stimulus, and structural reforms to revive the economy. The results were limited. By 2016, the central bank resorted to negative rates, applying a negative 0.1% rate to commercial banks' excess reserves. From the asset bubble's collapse to negative rates, Japan's path took 25 years, but followed a clear trajectory. Bubble burst, rate cuts, zero rates, quantitative easing, and finally negative rates. China's situation feels strikingly similar. The real estate bubble is beginning to deflate. Local governments face fiscal challenges. Policy rates are at historical lows. CPI is weak. Deflationary pressure are evident. Consumption and investments are sluggish, and money remains idle in the banking system. Japan's 25-year journey from deflation to negative rates is one China may complete in just 10 years at an accelerated pace. If China enters a negative interest rate era within the next decade, who will bear the greatest burden? It won't be the large corporations or major funds, but ordinary Chinese citizens, particularly middle-class families with savings but limited means to hedge risks. First, your deposits will no longer be entirely yours. Negative interest rates don't merely eliminate interest payments, they require you to pay a fee to keep money in the bank. In Japan, some withdraw cash to store at home, but in China, this isn't realistic. Strict cash regulations mean withdrawing large sums triggers scrutiny. Banks may demand explanations and report transactions to anti-money laundering authorities, effectively locking your funds in your account. Second, the middle class's conservative financial strategy will be dismantled. Typically, China's middle class allocates assets to deposits and fixed income products for their low risk. But when banks offer no interest and charge fees, the fixed income products yield nothing due to management costs. The cash flow that the middle class families rely on vanishes. For families supporting children, elderly parents, and mortgages, this financial strain could become overwhelming. The middle class will face a dilemma: remain cautious and watch assets erode, or take risks in stocks, real estate, or even cryptocurrency, betting on future gains. One path leads to gradual loss. The other is fraught with uncertainty. Which would you choose? Third, banks will shift from service providers to fee-driven entities. Negative rates will strain banks with deposit outflows and a compressed margin. To survive, they will rely on fees. Account management fees for deposits, fees for wealth management products, subscription fees, redemption fees, credit card fees, withdrawal fees, and more. The bank interaction may come with a cost. And the loans, the criteria will be far stricter than expected. With loan rates so low, banks will hesitate to lend to ordinary individuals. Loans will become a privilege for the well-connected, who can access near-zero cost loans and channel them abroad for profit. China's elite version of Mrs. Watanabe. So how can ordinary people prepare for a negative interest rate era? Time is limited. Our estimates suggest a decade at most. First, discard the notion that a saving equals security. Previously, bank deposits were considered safe, but in a negative interest rate era, conservatism accelerates asset erosion. Ask yourself 3 questions. First, is 3 to 6 months worth of living expense sufficient? In China, given potential disruptions like past lockdowns, how much is truly enough? Second, does keeping excess funds in the bank pose a risk rather than a safeguard? Third, have I considered where my money should be allocated? Without adapting your mindset, no amount of savings will protect you. Second, reconfigure your asset portfolio. In a negative interest rate era, interest-dependent assets will lose value. You must seek assets that counter depreciation, even if imperfect. Low volatility, high dividend blue chip stocks such as bank stocks offer stability and cash flow. Scarce assets like gold are another option. If feasible, allocate some overseas or dollar-based assets to hedge against yuan depreciation. This isn't about speculation, but about diversifying risk and preserving wealth. If you refuse to learn about investing, you risk becoming the most vulnerable target in a negative interest rate era. Third, prioritize cash flow and earning capacity. Investments alone won't suffice. You need a reliable income. Evaluate your primary income's stability, your ability to support your family without the bank interest, and the potential side hustles or online monetization. These factors determine whether you can sustain yourself independently or remain reliant on external support. Cash flow is your first defense against risk. Finally, and most crucially, maintain your health. This is vital in any context, but especially in a negative interest rate era. With fewer job opportunities, declining incomes, and fluctuating prices, physical health is the foundation for survival and adaptation. Without it, opportunities pass you by. In economic downturns, job losses and reduced incomes often coincide with declining insurance coverage. Yet, medical costs remain high. A serious illness could devastate a family's finances. Preventive health practices, diet, exercise, and sleep are more critical than ever. Economic hardship brings stress, anxiety, and depression, which disproportionately affect the physical vulnerable. A strong body mitigates this pressure. Regular routines and exercise are essential for resilience. In conclusion, the negative interest rate era is not a sudden calamity, but a reality approaching steadily. By awakening now, you have time to reposition, learn, and plan. This era won't reward passivity or delay. Those who act early will stand resilient. Prepare today to weather the storm tomorrow. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, be well.